All right, let's see. Okay, I think we are all here. So I'd like to thank our IIANC members who are participating. We appreciate you taking time out of your busy day to spend time with us this morning to learn more about our newest IMS market, CNA. For those of you not familiar with IMS, it's Independent Market Solutions, and it's an IIANC member benefit that you will have access to carriers without having an upfront volume commitment. If you have any specific questions about the program, please give me a call. I would appreciate the opportunity to discuss with you. And thank you to Brian and John with CNA for taking time out of your busy day to educate our members on your product. A couple of housekeeping items. Please mute your phones. And if you have any questions, we do have the chat feature. So without further delay, Brian and John, I'll let you take it away.
Hi, everybody. My name is Brian Siddick. I'm an underwriting director here in Sioux Falls. I wanted to show you a picture of a real life underwriter, just so you didn't think we all had horns on them. I know the relationship between an agent and an underwriter can be fun at times, but I want you to also know that I sympathize, because during the pandemic, I got really, well, I was looking for something to do, so I got my property and casualty license. So I am also a licensed insurance agent, and I have to take continuing education credits. I just remembered that. So hello, I'll let John introduce himself, and then I'm going to try and go off video, so you will hear this embodied voice, but John, take it away.
Yeah, welcome. My name is John Weiland. I'm the channels director at CNA Surety, meaning I'm the point of contact for different relationships like insurance associations, insurance groups, and we will give you ways to contact us absolutely after as the presentation wraps up, but we absolutely want this to be an interactive session. So as we're going through this, if you have any questions, just feel free to chat, feel free to come off mute, ask some questions. We're going to be very flexible, and we try to keep this a little bit interactive, and you will make it a great presentation. So thanks again for the opportunity, and thanks for letting us talk a little bit about bonds. Brian?
Okay. I promise this will be painless. And so Surety Bonds explain, what we're going to try and do is just give you a little bit of a background of what a surety bond is. A lot of times when I talk to agents, they don't come across surety bonds that much. And when they do, it's like they have to sometimes just relearn it all again. But what we try and do here at CNA Surety, especially in the small commercial unit up in Sioux Falls, is take away any issues or concerns you have. If you don't have to be an expert in surety bonds. If you have one or two bond requests a year, you pick up the phone and call our 800 number. We have experts there to talk to you. We have 30 to 40 individuals answering the phone calls, over 2,000 phone calls a day, that they can have answers to your questions. And if they can't answer them, then they can transfer you to an underwriter as well. So we want to make it easy on you to do that. So surety bonds defined. What is a surety bond here? I'm not going to read this all the way through, but just point out a couple of things. It's a written promise. Another thing, it's a three-party contract. So there are three parties involved with the surety bond, unlike an insurance policy with only two parties involved. The one party, the surety, guarantees performance or obligations of a second party, the principal. And that's a difference. We refer to, you might, for an insurance policy, they're insureds. We refer to them as a principal. And then there's that third party obligee involved. And a lot of times, it's the requirements of those obligees that make it difficult to process bonds accurately and more efficiently. So that's it, but they are a very important part, because without the obligee requiring a bond or wanting to have a guarantee, there wouldn't be a need for a surety bond in the first place. So it is a written promise, and it is a third party contract: surety, principal, and the obligee. And here is just a visual representation of it, of the three parties. And you can see the arrows that are going around it. So you have the principal at the top, and goes to an agent to get a bond. That is the surety company on the lower left. And then the bond is provided to the obligee on the lower right. And then the obligee requires or offers a license or signs the contract with the principal, and it just kind of goes around there in a circle. So we're all related. We all feed into each other. And if you reverse those arrows on this representation, it's basically the same thing, because the obligee, if there's a claim, they go to the surety company. If the surety company goes to the principal and says, hey, are you going to address this claim? If not, then the surety will come back and pay the obligee. But sometimes the principal makes good on their promise and then rectifies the situation with the obligee. So it's just that circular relationship between the three parties to the agreement there. Principal required to obtain the bond. The obligee is the party to whom surety and principals are bound. And the surety is the party who takes responsibility for another. So the bond doesn't protect the principal. In most cases, the bond protects the obligee or unknown third parties there. So the easiest way that I have found to explain the difference between surety and insurance to my wife, to my daughters, to anybody I work with, because whenever they hear I'm in bonding, they go, oh, how's the stock market? No, it isn't like that. I deal in commercial surety bonds, and they get this blank look on their face. Because if you think about it, if a surety underwriter really does their job well, nobody knows about it, because we don't write bonds for every applicant. We go through the process to try and be selective and write risks. So it's a different animal, and it just takes some time to get used to it. So, but the easiest way is to contrast it with insurance. So a surety, as I pointed out, a surety bond is a three-party agreement, whereas an insurance policy is a two-party agreement. You have the insured and you have the insurance company. With the surety bond, you have the obligee, the principal, and the surety company. Losses are not expected under a surety bond. When we write a bond, we do not expect there to be a loss. We expect that applicant, we have qualified them, and it's similar to a bank loan. When you write a bank loan, you expect that it will be paid back. It will not go bad, similar to what a surety bond does. However, with insurance, losses are expected. When you write an insurance policy, the actuaries have looked at it and have determined what premium do we have to charge, and assuming there's going to be a loss underneath it. So under a surety bond, what makes that difference from insurance, though, is if we pay a claim under a surety bond, we can go back to the principal and ask for reimbursement of that loss. Now, there's a couple of differences there. If we pay a claim under a bond, under common law, we have a right to get reimbursed for that. That's English common law, and it goes back hundreds and hundreds of years. However, we can't recover expenses associated with the claim itself. That's why we get indemnity agreements, to get the principals to promise to reimburse us for all the losses and expenses that occur. With insurance, generally, you're not going to go back to the insured and said, hey, I just paid your a claim under your car insurance. Now you have to pay us back. So that's just another difference there as well. Premiums cover expenses with the surety bond. So think of it more like a bank loan. where you get charged fees, underwriting fees and expenses to do the underwriting of that risk. But we generally do not factor in loss history when determining claims. Generally. Now, there is some factor there. What you find is the risks that require more underwriting or have more teeth and potential for a loss there, then we do charge higher premiums. But it's more to cover the expense of underwriting that it takes to underwrite those more hazardous risks rather than assuming losses. Because once again, we don't assume that when we write a bond, there's going to be a loss. Whereas with insurance, as you know, premiums cover losses and expenses. It is built right in. And that's how insurance premiums are factored. And then sureties are selected. If we don't like an applicant, we decline. But I would be kidding you if I said there is not a surety out there that wouldn't write every risk. They may charge higher premiums, they may require collateral, but you could probably find, for most risks, find a surety if you're willing to pay enough and meet their conditions. But generally, if you're just thinking about it, we either decline or we accept a risk. With insurance, they write most risks if you want to pay the premium. Okay, so here's the premium, and the higher risk get charged higher premiums. Our rates are set based on the risk itself. So if we have to charge the same rate for what we feel is a high quality applicant versus a lower quality applicant if all other factors are the same. Now, we are starting to get into using credit reports more and more in our rating for that as well. So there's a little bit of a factor there, but for the most part, sureties select which risks they want or don't want, and insurers write most risks. Now, when you see a bond form, unlike an insurance policy, you can go to the policy itself and see what coverage it provides. You can't always do that with a bond form, because if you think about it, there's an underlying agreement that the bond form or the bond guarantees. And so to know really all of what a bond guarantees, you have to know what that underlying statute or agreement is, along with the conditions of the bond form. But there are some general provisions in a bond form that I'm just going to point out to you so you can get used to looking for it. There's an insuring clause, excuse me, and that's similar to the insuring clause in an insurance policy. It just states what the policy in an insurance policy is insuring. There is a bond. It says this is what the bond is guaranteeing here. It says more, we are guaranteeing, like a license and permit bond, we are guaranteeing that this person for their electrician license, okay? But to know what the electrician has to comply with, we have to look at the underlying statutes. There's a reason for the bond. It tells why the bond is required and what it guarantees, the conditions of the bond itself. There is the surety guarantee. This paragraph merely says that the principal doesn't pay or perform the duties as prescribed by law or according to the underlying agreement, the surety will pay. It's as simple as that. And then there are other provisions in the bond form that you always have to look at. We generally like to see cancellation clauses in bonds, because if you are underwriting a bond, you can underwrite for generally a year or two, but you don't know what the financial condition is going to be of an applicant in a couple of years. So we want the opportunity to, at certain points in time, re-underwrite the risk and get off the risk if the circumstances have changed. So that's the cancellation provisions we look for. Not every bond has a cancellation provision. That doesn't mean that we don't write the bonds. It just means that we have to factor in different underwriting conditions to consider that. Forfeiture. With the surety bond, the bond is there to pay any claims or losses that occur. So let's say a $25,000 bond. If somebody suffered a $10,000 loss, generally the surety bond would pay for that $10,000 loss. However, some obligees want the bond to be punitive in nature. So they have what's called a forfeiture provision in it that says even if there's only a $10,000 claim on the bond, the entire $25,000 amount is going to be forfeited in the event of a claim. Okay, then there's another provision called cumulative liability that generally when we write a bond, the bond is good for a 1-year term. And then if it renews or it renews with an invoice or a continuation certificate, it doesn't accumulate liability each term. But there are some provisions in a bond form that says, okay, if there's a $10,000 bond for 1 year here, and then you write a new $10,000 bond, you are liable for $10,000 for the first term, $10,000 for the second, $10,000 for the third. So the liability of the surety and the principal accumulates up to $30,000 in that case. Now, there are many ways to apply for a surety bond. I'm just showing you the old-fashioned paper kind right now, but one of the easiest ways that we make it easy for agents to apply for a bond is through our Bondline online system. You don't need to know you don't need to know where the information goes or anything like that. We set it up to ask you the specific questions to tell you what you need for the particular risk that you have chosen. And that's all you have to provide. And so I would highly encourage you to use our Bondline system. And that's a great thing is I'm telling you this boring stuff about what a surety bond is. We have underwriters that can provide demonstrations to you to walk you through our Bondline system and show you how easy it is. If you have a specific type of line of bonds, like license and permit bonds or contract bonds or probate bonds that you are interested in, we can develop this same type of presentation, but make it specific to that. We want to make it easy for you. We want to make it easy for you to write bonds. So this is a general application and it provides basic information there. A lot of times just what you will see is enough information to begin the underwriting process, just general. A lot of surety companies are going now to credit report underwriting. So that's why you need the social security number and applicant's full name and residence address. Some types of surety bonds, not all of them, need financial statements. So you could complete a financial statement right on there, or you could submit financial statements right along with it. And I talked about indemnity down there, that this application allows you to obtain that indemnity as well, that promise from the principal. On the back side, this is general information. Not everything is required for every type of bond, but then on the back side of our Form 10, it gets down to specifics where you choose the type of bond you need and then provide us with specific information there. Whoops. And I missed that and I can't go back. Oh man. Oh, previous. There you go. Okay, so this word indemnity. I don't know if you get that or not. I learned about it in business law class in college, and I didn't think I don't need to know what indemnity is. Lo and behold, I started a job, and for 34 years, I have to know about indemnity every day. So what the indemnity is, it provides a promise from the principal to pay us back for premiums and any losses that we pay under the bond, but also any expenses we incur. Okay, so we have that common law thing, and so a lot of bonds we don't require indemnity, but it's the larger bonds or the more financial guarantee in nature where we need to get indemnity to get that additional protection. Now, indemnity, it makes it difficult because you just can't sign your name to provide indemnity. It depends on the type of business entity that is going to be the principal on the bond. And then if we want to get indemnity from that business entity as well as the owners personally. So for a corporation, you see here, we have to get John Doe signing as president or a vice president. They are saying the corporation will reimburse us for any expenses. And then John Doe and James Doe, they are the two individual owners of that corporation. They are saying we will personally guarantee you that. And then their spouses are also signing. And the spouses are saying we will personally guarantee that if you incur any expenses, we will reimburse you. A lot of times I get asked, why do spouses need to sign when they have nothing to do with the business? Well, what we try to do is make it more efficient for you. And a lot of personal assets are owned jointly. So instead of asking you to verify which assets John Doe owns versus his wife, Jane Doe, owns, and getting all that information, we just say, hey, both of you sign. That'll take care of it. Then we don't have to go in depth and get that more specific information there. I will quickly go over bond renewals. Not every bond renews the same way. There are bonds that are continuous in nature and they renew with an invoice. So they are continuous and in force until they are canceled by the surety. And as long as the renewal premium is paid, the bond continues. Okay, there are some bonds that cannot be canceled. So even if the principal doesn't pay the renewal premium, we're still on it. So we have to do other ways to get that. But statement or invoice, that's for continuous bonds. And then there are also continuation certificate. This is when the original bond has a specific effective date and an expiration date. The renewal continuation certificate is filed with the obligee, and it just says, okay, that original $10,000 bond, it is just continuing for another term. It has to be filed with the original bond, but it does not accumulate the liability. So in this situation, that $10,000 bond, if it is in effect for 5 years and renews with the continuation certificate, the total obligation to both the principal and the surety is only $10,000. Then a bond can renew with a renewal bond. That's the same thing when there is a set effective date and an expiration date in the bond. The difference here is there is a bond for each term. So in that same scenario I just said before, if there are 5 $10,000 bonds for a 5-year period, there's 10,000 coverage for each period. So a total of 50,000 to both the obligee, or to both the principal and the surety. So cancellation of bonds, it's dependent on the bond terms. A bond can have a termination date in it. And if it has a termination date, then you don't need to cancel the bond. It just ends at the termination date or the expiration date. Some bonds are continuous and have a cancellation provision. And then the surety can issue notice of cancellation as required in the provision, either by giving the obligee 30 days or 45 days notice. Because keep in mind, the bond is to protect that obligee. So if the principal requests cancellation, we still have to notify that third party that the obligation of the bond terminates. Now, there are some bonds like probate and public official that John will talk about, that they are in effect as long as they are needed, and we cannot get off them at the surety, and the principal can't even cancel them. There, we have to ask for releases from the obligee to get off the risks. So if you ever have a question on what a bond form, if it can be canceled, pick up the phone and call us. We can answer that question for you. Now I'm going to turn it over to John, but before I do, just want to check in to see if there are any questions. All right, take it away, John.
Yeah, thank you, Brian. Hopefully everybody can hear me. And again, really appreciate you attending, hanging in there, and hopefully we move now from learning the definitions and the basic concepts of surety bonding to helping you figure out how you can make a little money, how you can build client loyalty, and how you can become the expert in your agency on different kinds of surety and fidelity bonds. I want to start by talking about license and permit bonds. And, with the how do I make money in selling these, we're going to show you the nationwide market size for each of these 8 bond families, along with the state of North Carolina estimated market size. We apologize that this data is from 2019. Just within the last couple of weeks, the Surety and Fidelity Association of America has brought out the 2020 numbers. So this isn't really a product of CNA Surety lagging. The Surety and Fidelity Association is a little bit slow in compiling these numbers and getting them out to their member sureties. But as you can see, the markets nationwide and in North Carolina are both substantial. We'll talk about license and permit bonds now. License and permit bonds, sometimes you'll hear them referred to as L&P bonds, guarantee the licensee will operate according to the law the government entity has established for that trade or profession, or that the principal will comply with the terms of the license and permit issued. That's a big definition, basically meaning the bonded principal will do the work in the way the statute ordinance says they will do that. Cities, counties, states can all be obligees, and the specific bond guarantee, as Brian referred to, is codified in a statute or ordinance. So often what you'll see is a bond form refers to an ordinance or a statute number, and that helps us completely understand what obligation we are expecting the principal to complete. Obligee transfers that qualification process to the surety company. So if, for example, a certain city or county in North Carolina said, we are going to be our own surety, they absolutely could take that time, qualify based on each contractor's background, and avoid a bond. But we believe, and for decades and centuries, sureties have offered a valuable service by qualifying that licensee. If the wrong licensee gets qualified, a claim could result. The state, county, city simply contacts the surety makes it right, and then we do have the ability to pursue the principal for reimbursement. We're going to talk a little bit now about the types of license and permit bonds. As you can see at the top, we've listed some various contractors, car dealers, pawnbrokers, collection agencies. These are all occupations or industries that require an applicant to obtain a license and permit bond. And then you can see 4 bullets below that. Those are listed in least risky to the most difficult to underwrite. Quickly covering those, regulatory bonds put limits on businesses and guarantee they'll operate according to the law or ordinance. Normally, these types of bonds are small, required locally, and they're underwritten freely. The example would be an electrical contractor required to get a bond by a city. The next level of difficulty are public safety bonds. Types of these bonds are demolition contractors, house movers, sign hangers. These are types of professions that could inflict financial loss because of physical damage that could occur during the course of their work. Third, we talk about public protection. They protect the public against loss due to financial damage rather than physical damage. Often the surety will use a credit scoring tool and ask about experience, reputation, etc. to consider public protection bonds. An example of this are motor vehicle dealer bonds, employment agencies, and collection agencies. Finally, the most hazardous, the most carefully underwritten are financial obligation bonds. In no way do we mean we won't underwrite these bonds. They simply require more information for us to, to select the risk. The financial obligation bond guarantees the payment of money if the principal fails to pay taxes or charges. Really, as a surety, we're guaranteeing that business will continue to survive so they can pay their bills. Full financial are often needed and many times will ask for full or partial collateral. Examples of these bonds are liquor tax, gas tax, sales tax. How do we develop license and permit bond? How do I use the knowledge I'm obtaining today to actually put premium on the books? Some of these are you may have fresher views. You may have a better view to your local city or county bond markets. But one way is to attend or view commission meetings. Watch for new construction and remodeling of buildings. You'll see who the contractors, who the tradesmen are in your area. Make regular visits to the city clerk's office. I think this is a key one. If you build that relationship with the city clerk, let them know you're an active referral for bonding. They will often send folks your way, and then build that online presence. And we have ways to do that at CNA Surety. Simply reach out to us, have them put you in contact with me. I'll help you with that. And then work with, your commercial real estate firms. They often have a pretty good pulse on who's going to need bonding. We will go ahead and switch to our next family, and this is Fidelity Bonds. These are often referred to as honesty insurance. When we talk about Fidelity Bonds, they are only a two-party agreement. The obligee is the insured, and the coverage is the insurance. So it generally protects the employer or the business owner from loss due to dishonest act by a bonded employee. So this is a heck of a good thing to have. You can advertise, we are bonded against, our employees are bonded against theft. Oftentimes this is a selling tool for janitorial services or cleaning companies or places that actually go into others' homes. Varying coverage amounts are available. Coverage is needed is determined by the access the employee has to goods or money at any one time. Purchase of this bond is by the choice of the applicant and not generally required. So while a third-party obligee like a city, county, state doesn't require this, that can be a good thing. You can go ahead and sell this coverage to existing clients. One of the first coverages we're going to talk about is our dishonesty form A. This covers the employer's property only. It's designed for those businesses with less exposure, where the risk has been historically low, and it is rated as such. Accountants, doctors, dentists, and attorneys would be typical markets for Form A coverage. Nonprofit coverage falls under Form A when we make it available to the officers only. Volunteers, because they're generally not screened, are usually excluded from Form A coverage. And to establish that a claim can be paid, the surety really only requires proof of loss. The next form I'll talk about is our Form B, and that's designed for businesses with a little bit higher exposure. We think of gas stations, restaurant, and retail operations. This type of coverage requires conviction in most states. In North Carolina, an indictment. This meaning the employee must be indicted of the theft for coverage to apply. Subscriber liability exists under Form B, meaning that those who subscribe to a business's service may have coverage. Now, subscriber liability is not direct third-party liability. The claimant must still make the claim through the employer, not directly to the surety. And then finally, we talk about janitorial services. This is a product specifically designed to cover the subscribers or customers of a janitorial service business against a dishonest act by an employee. The janitorial service bond contains a conviction clause. It includes subscriber liability. Again, it's interesting coverage because the employer's property is not covered, but those who subscribe to the janitorial services are covered. There is a $100 deductible per claim on the CNA Surety coverage. Keep in mind, if you go to cnasurety.com or go on to our online issuance tool, Bondline, this is a very short application process. We typically, all that is asked is describe your business, tell us the number of employees, and since these are all blanket, make sure that all full and part-time employees are included, not just the high-risk individuals. How do I develop Fidelity Bond business? Well, you can absolutely, and your marketing rep, once you sign up with cnasurety.com, can give you supplies of brochures to send with renewal notices to commercial clients. Let folks in your local area know that you are a market for these Fidelity Bonds. Your local Chamber of Commerce meetings are excellent places for you to network and sell this coverage. And you can look at your commercial client files and see if they already have existing coverage. If not, it's an excellent way for you to build additional business. The next way we're going to talk about are fiduciary bonds, often known as probate bonds because they are generally required by a probate court. A fiduciary is nothing more than one who handles the affairs of another or takes control of someone else's property. In this case, often a bond is needed. You may hear terms like administrator, guardian, guardian of minor. A fiduciary bond guarantees an honest accounting of assets and the faithful performance of duties required by law. It guarantees the ward or decedent's interests are safeguarded, nothing more. Jurisdictions vary on if a fiduciary is required to be bonded. It's important, if your particular jurisdiction does not require probate bonds, to advocate for the importance of bonding. Oftentimes, a relative appointed as a fiduciary may not handle the assets according to law. And if those things are mishandled, at the end of the day, really, there's no one to stand and protect that deceased estate or the ward. Market size, about 5 million in North Carolina. We're going to dive a little bit deeper into administrator, executor, personal representative bonds. They are required after someone has passed away. If there is no will, the court generally refers to the appointed individual as an administrator or personal representative. If there is a will, they will typically be referred to as an executor. What are their duties? Well, the first thing and overarching is to honestly and faithfully perform their duties. Digging deeper into what does faithful performance mean for an administrator, basically, if they were to honestly invest administrator funds into a risky investment and lose that money, that could be a violation of their faithful performance duties. Typically, their duties are to gather the assets, sell the estate assets, or see that they go to the proper parties, and then file those regular accountings with the probate court. Very important here. Brian touched on cancellation. A fiduciary must be relieved of their duties by the court. Before we can close our bond file, we must have some evidence that they've been relieved of those duties by the court, meaning they did their work, they filed their accounting, their order or their accounting was approved, and they've been discharged. That's the example where Brian brought up, hey, we can't cancel it, and neither can the administrator, executor. It has to be released by the court. Next, we're going to cover guardian or conservator of an incompetent bond. They're required by the court when that person is unable to handle their own affairs. So what are their duties? Rather than gathering the assets to distribute them, the guardian works to preserve the assets for the ward's benefit. So they want to be very conservative in their expenditures on behalf of that ward. Typically, we do want to see a guardian have an attorney advising them. If they make payments to a nursing home, medical bills, we want to see that done in a very timely manner. And again, the court will require accountings as evidence that the ward's income and expenses and efforts to preserve those assets are only for the use of the ward. When the ward recovers or passes away, that's when the court will release the bond. Again, it's not up to the surety and it's not up to the principal to get those bonds canceled. They need to be released by the court. Next, we're going to talk about conservator or guardian of minor bonds. Minor children cannot receive insurance proceeds or estate assets. Someone must be appointed to manage these funds until that child has reached the age of majority. Depending on the state, that age of majority is 18, 19, or 21 years old. The guardian or conservative will safeguard and preserve those funds until that child reaches the age of majority. We have found this to be a fairly hazardous type of probate bond because often there is misunderstanding about what sort of expenditures are acceptable to the court. If you're appointed guardian, they can't use the minor's assets for everyday expenses of the family if and only if the court specifically approves or authorizes it, can the guardian spend funds on the minor's behalf. Payment for tuition might be an example. In this situation, the guardian also files annual accountings and a final accounting is required at the end. Often you will see sureties ask for premium payment in full until the minor reaches age of majority. So we're going to move. It's absolutely not the most exciting line of bonding, but there are lots of opportunity to write fiduciary bonds. Make sure the probate court is aware that you do fiduciary bonds. Solicit business from attorneys who are your clients, and just let your personal lines customers know of your ability to handle fiduciary bonds. It's a very, very important service you can provide to your clients. Court bonds are the next type of bond we want to talk about. Generally, court bonds describe all bonds required of the participants in a civil lawsuit. It permits the principal to pursue remedies in or through the courts. An example is an appeal bond or a replevin bond. Plaintiff bonds are generally easier to underwrite. So if somebody comes in and says, I need a court bond, ask them, are you the plaintiff or are you the defendant in the case? Often if they are the defendant, we start looking at things like collateral, and it is a tougher market to issue for defendants, much easier for plaintiffs, and the market size is substantial, as you can see, in both the US and in North Carolina. You will often hear plaintiff bonds referred to as attachment, replevin, indemnity to sheriff, eviction, cost, and appeal bonds. Defendant, appeal supersedious. Counter attachment, counter replevin, cost, and release of mechanics lien. So as you hear these different phrases brought up, simply register. You shouldn't try to remember them all. Simply register what they want. Ask if they are the plaintiff or defendant. That will get you a long way to a written bond. How do we develop? Again, we contact attorneys who are our clients, and let those court clerks know that you are an active and available market for court bonds. Next, Brian talked briefly about public official bonds. Risk to some extent the same as that involved in fidelity bonding. The bond guarantees the public official will fulfill their duties honestly and faithfully according to the law, though the bar is set higher for faithful performance, meaning an innocent act could be covered if the action causing loss was not prudent or reasonable. The bond protects only the public, not the public official. An interesting idea around the faithful performance is if a city treasurer were to take and invest the city's funds into a bank that eventually failed. The city treasurer did absolutely nothing wrong, but the bank failed. There could be a claim in that situation for lack of faithful performance. Perhaps the city treasurer should have done more research on the strength of the bank, or required the bank to designate some deposits towards city funds. Any level of government may be required to get a bond. Those public officials that handle funds, like treasurers or tax collectors, typically have higher bond amounts and higher premiums. Those that are administrative, that do not handle public funds, like auditors or peace officers, typically require smaller bonds, and the bonds are more easily written and rated less expensively. And then there are different types of public official bonds. There are individual bonds written in the name of one individual public official, schedule and blanket bonds. Schedule bonds are written in the name to cover multiple public officials. Blanket bonds are written in the name of the government entity to cover all employees of that government or department. The bond type is actually set by law or statute in some cases. The obligee sets the amount when the bond is not required by law or statute. How do I develop public official business? Let local government officials know that you have a market. Solicit business before elections. Next, I want to talk about notary public bonds. Unfortunately, North Carolina does not have a notary public bond. They do have notaries, and certainly we do have a product to protect the notary. So, notary public bonds is actually a form of a public official. It protects the public by guaranteeing the notary will faithfully and honestly perform the duties of their role. In most cases, that's witnessing signatures and validating the person who signed was actually identified and was the person who signed the legal document. I'm going to move to notary E&O. Notary public bonds protect the public, not the notary. And so the important part there is often if you're a notary, even though you are not bonded, you could consider purchasing errors and omissions coverage. Now that protects the insured, the notary, and that protects against liability due to an unintentional error or mistake. It covers legal expenses up to the limit of the policy. It's no deductible, and it can actually be used to cover the deductible of another policy. Employers can purchase a group notary E&O policy. How do I solicit notary E&O business? Get a listing of the notaries public from the Secretary of State or other filing authority. Contact local businesses. Again, bonding is an accommodation business. Let them know you are there to accommodate their notary E&O needs, and sell an E&O policy with every notary E&O bond. Miscellaneous bonds. This is really a catch-all. It offers many types of protection: honesty, compliance, financial guarantee, performance, or all of the above, based on many types of agreements where someone needs protection from a potential failure to perform. Airline reporting corporation bonds, lost instrument, indemnity to union, wage and welfare are all examples of miscellaneous bonds. The bond form and the underlying agreement are typically part of your underwriting submission so that the underwriter can see what that miscellaneous bond is actually guaranteeing. How do I develop these bonds? Again, let your clients know you're available to issue these types of bonds. Those we target are typically like travel agencies or those who would require such a bond. The next market I want to talk about are federal bonds, and we are getting to the end here. Thank you so much for hanging in there with this. These are important distinctions to make. Federal bonds are required by the federal government. They're similar in their guarantees to license and permit bonds, but they're required federally. Often they have financial guarantees, payment of fees, or compliance with all potential bond conditions. You will hear contract postal stations needing this type of bond, customs bonds, durable medical equipment bonds, federal liquor and tobacco tax, federal wineries. Often these kind of bonds are required, are what you would hear when we talk about federal bonds. Difficult to estimate a market size because the SFAA includes those in license and permit and some public official. Finally, what I want to land fairly hard on is the contract bond market. This guarantees, and this is a huge market, both federally and in North Carolina. A contract bond guarantees the fulfillment or performance of obligations relating to a written contract. Public or private obligees can require contract bonds. This is significant nationally and in North Carolina, as I said. There are 4 primary types of contract bonds. The first is a bid bond. That's submitted with a contractor's bid and guarantees the bidder, if they are low, will enter into the contract at the price bid and provide the final bonds. So the bid bond is generally 5 to 10% of the contract amount, although we do see other amounts. So again, the bid bond means that if they are low, they will enter in and be able to provide the required final bond. That is why often you'll say, well, my client just needs a 5% bid bond. Yes, but as a surety, we need to underwrite our ability to provide them with performance and payment bonds, because if they are low and we don't provide those performance or payment bonds, we could see a claim on the bid bond. So I talked briefly about performance and payment bonds. The performance bond is submitted with the contract, and that protects the obligee against financial loss if the contractor does not fulfill the terms of the contract. So if I'm going to put carpeting in a county courthouse and I don't pay my carpet supplier, or I do poor workmanship, or I don't get that work done, that is where the performance bond comes in. The payment bond is submitted with the contract, and performance bond and guarantees that contractor will pay suppliers and subcontractors. A contractor generally will need both performance and payment. They may even be written on the same form. There is also a maintenance bond, and that might be required and is typically provided after the project is completed, and that covers defective workmanship and materials for a warranty period. The supply bond guarantees the performance of a contractor to furnish supplies and materials. Typically, there is no installation or workmanship involved with the supply bond, and accordingly, it's rated a little bit less. When we start talking specifics around CNA Surety, we have a fast track program for your small and emerging contractors. We can pre-qualify those contractors up to a $500,000 single contract or a $500,000 aggregate. We also have an aggregation program with just a little bit more financial information allows us to pre-qualify that contractor up to $500,000 single and $800,000 as an aggregate line. How do we develop contract business? Basically, it's pretty obvious. You target your contractors, target your tradesmen, target those artisans who are starting to engage in the smaller bonded projects. If you see somebody come in and require a license and permit type bond, let them know you're available to provide them with their contract bonds. We often see agents who have a desire to build this book join local trade associations related to those contractors. Your ability to work with CNA Surety and provide fast turnaround on providing performance, payment, and bid bonds will be invaluable to contractors, and you can certainly grow a business just in that market. So, Brian, I'm going to ask you to go to the last slide. There's quite a bit here. The one thing I really want you to maybe jot down coming out of this quick presentation is cnasurety.com. That's really your gateway to our 800 number where you can talk to bond experts. It gives you an email where you can send general bond questions. And, it's 24/7. It's your access to Bondline, which is our bond issuance wizard. Gets you to our service associates who work from 7:30 to 6 p.m. Central Time. And finally, each agency working through the independent insurance agents of North Carolina who gains a contract with CNA Surety will absolutely have their own marketing representative who will be there to help you with any service concerns, any marketing ideas, and just to keep you updated on your local market and bond news as it comes out. So at this point, I'd really like to thank Gina, open this up for any questions, and just absolutely ask you to reach out to us as a partner to the Independent Market Solutions so we can provide more as we go forward on bonding.